Welcome back to the nationally recognized Real Estate Radio Network's Don and Gino Real Estate and Finance Radio Show on your hometown station, AM 1220 KHTS. Make sure to get great information or ask your important questions at donandgino.com. Now, back to your friends, Don and Gino.
Well, we have some friends out there. That's right, on the Don and Gino Real Estate and Finance Show every Thursday from 12 p.m. to 2 p.m. And our chat room is growing. That's right, we have a chat room now for whopping 3 weeks. So it took us 2 years to get going. And it just took me, quite a few years to realize there are no dials out there. But I have proof. On our chat room, Dilza, who works in our office, and she's amazing and kicks butt with our team, she says she still has a dial. So there, Gino.
Well, hey, there's a few of them out there. What are you going to do? But overall, I think, pretty soon we'll all just be, like Siri on iPhones. We'll just be speaking to everything. It'll finally, I know we're probably like 20 or 30 years behind in technology from where people's imaginations and dreams were 50 years ago. We don't have flying cars. I mean, someday that will happen probably, but still not there yet.
At least not on purpose.
That's true. And still not there yet. And, but we do have, remember the old, what was it that they used on Star Trek, which was basically a cell phone.
Dude, that was the coolest cell phone when that came out. The little flip phone.
Captain's log.
No doubt.
Yeah.
Okay, so thank you again for joining us on the Don and Gino Real Estate and Finance Show every Thursday from 12 p.m. to 2 p.m. And you're at our finance hour, and our finest hour right now, because we have John Vance with Vance Wealth Group. And he's sharing with us some great information. I mean, like I said, I have 4 pages of notes from this guy. He knows his stuff. He's confident about his stuff. You'll notice, please listen to his demeanor and how calm he is, because that's a true professional. It's the people that are running around with their hair on fire trying to figure things out because they don't really know what they're doing. They're just running by the seat of their pants trying to sell. There's a difference between selling and knowing, and John knows. He knows his stuff. I mean, like I said, and we know because we interview a lot of people now, and we study like no one, and John knows his stuff because you can see that the numbers he has here are across the board dead on with what's going on in the economy, what's going on with the government, what's going on with opportunity right now. And the main thing we were talking to John about, he was nice enough to share because he's got 4-page notes, but we wanted to stay on where we're at right now with the rising stock market and S&P and what that means to you. And we wanted to talk about 2 things. One, what the investors are doing. We're talking big money because it's easy for all of us to get caught up in emotions and excitement and euphoria for what everybody else is doing, sometimes not good, and John's going to talk about that. And 2, a really fun topic, I couldn't wait to talk about this with John, and he happened to hit the same thing I wrote down today in my notes. Sell in May, go away. And we're going to talk about what that means. Let's start with, well, let's complete our conversation regarding where we're at today with these markets being at top-notch levels and what investors have been doing for the last few years and what they're doing now.
Well, with the markets being at these high levels doesn't mean that it can't go higher. So things certainly can continue to rise. The fundamentals of the economy are slightly improving. The housing market, I think, is actually starting to help that.
It is.
The momentum in the housing market, I think it's really a mistake to underestimate the impact on the overall economy. But one of the things that we're looking at now, which is a little bit concerning, is that investors are starting to get a little bit a higher tolerance for risk. They're really looking out there and saying, maybe it's time to add more risk to the portfolio, where 2-3 years ago, when the markets were really inexpensive, they had no desire to. And that is a challenge. And so if you look back over the last 6 years, since the market top in 2007, money has been consistently flowing out of mutual funds, and equity mutual funds specifically, so stock funds. Money's been coming out in the billions and billions of dollars. And the first time since the top of the market in 2007, the first quarter of 2013, we saw money coming back in. And that is a concerning sign. Some people may view that as, oh, that's good, money's coming back into the market. Well, the dangerous part of that is the average investor is usually the last one to the party. They're usually the last one to invest. And one of Warren Buffett, who's one of the famed investors, greatest investors of our generation and probably of all time, his famous line is, you want to be fearful when others are greedy, and be greedy when others are fearful. And right now we're seeing people come in with that greed, with that sense of I need to take risk. And so I think for us as investors, we want to take pause and say, maybe it's time to rebalance the portfolios, take a little bit of risk down, so that we're locking in some profits.
Yeah, I think that's spot on. In fact, Don and I talked about the levels of a market, and there's investment, and then there's speculation, and what was the other one, Don?
Ponzi.
No, that's the last one, was Ponzi. Oh, there's hedge, investment.
Investment, speculation, and Ponzi.
Yeah, and so it's like, where are we in that category right now? Well, it sounds like people were doing good. They hedged their bets. They did well over the last couple of years. They invest. They were smart. Now it looks like we're moving into a speculative market. So that's
just like the housing market.
Just like the housing market was. So it's when we hit Ponzi that everything falls apart. And we want to make sure that we don't get there again. So please, please, please work with your professional and make sure that you don't lose up to 30% of your portfolio.
Actually, let's go there. John, how can they get a hold of you best?
You can call our office. It's toll-free 888-775-0950, or you can visit us at vancewealth.com.
That's probably the easiest way, because you have a great site. You have a lot of great information on there. You do blogs, you do information. I mean, it's a wealth of knowledge.
Yes, and you can go on there also, and if you want to contact us, there's an area that just says contact us, and it'll send us an email. And one of the things I'd like to offer to your listeners, if they would like to have a consultation just to kind of look at where they are, make sure they're not taking on too much risk. If they mention the radio show, I'll be happy to sit down with them for an hour and give them my time. So if they want to reach out.
So you're going to do that without even having to charge them for your expertise. Thank you for that, by the way.
My pleasure.
By mentioning Don and Gino.
There you go.
There's some value to listening to our show right there.
Seriously, I was trying to get people to give away pizzas for Don and Gino. He's giving away an hour of his time. Much more valuable.
Yeah, a lot more valuable, especially right now, because you should. I mean, please listen. You should have your portfolio looked at. A lot of times it's really easy. John, you probably see this all the time. I have to hit this one nail on the head, because when things are good, people basically stick their head in the sand and go, why should I even bother to look at it? If they don't properly prepare, we've seen statistics where they can easily lose 30 to 50% of their portfolio in a short amount of time if they don't restructure it correctly or protect themselves to risk or be prepared for that. Am I right?
Well, the markets have rallied from the bottom in 2009, roughly 135%, if you just look at the market levels on the S&P 500. So if you haven't really paid attention to your portfolio and things have rallied up, you're probably taking a little bit more risk than you realize, and in some cases a lot more risk. So it just makes sense to reassess, make sure your investments match your investment time horizon. That's really important. Right now everyone's thinking, let's add some more risk to the portfolio, but if you need the money in the next 1 or 2 years, you're taking a lot more risk than you realize, because as we know, markets got a mind of their own. They can go out of favor for a year or two, and if you need access to your money, you need to be a little bit more cautious with that. If you have a long time horizon, investing in real estate and stocks over a long time horizon, 5-10 years, has always been a good place to invest for Americans especially.
I have a quick thing that I just can't stop thinking about. Don and I at Cherry Creek Mortgage look at a lot of tax returns. And one of the things I see is very common right now is I see people that are claiming dividends and they're receiving interest, and they only hold one stock, their employer. How dangerous is that? I mean, when you look at Enron or companies like that you thought were great companies and you made a lot of money on that, how dangerous is that strategy? Because I know that there's some of our listeners listening right now that have that strategy in place. So what do you recommend for someone with that strategy?
Well, I mean, it's dangerous if it goes down, right? So that's always the problem, because as it's going up. I mean, talking to people from the technology, from a Microsoft or an Intel back in the late '90s, and suggesting to them to diversify their assets, they'd say, well, why would I do that? Because I'm making so much money here. So it's only when it goes down where it feels painful. So the challenge with why that's so dangerous for investors is that we all have a limited time here on Earth. We are not going to be here in perpetuity, and so your time to save and build wealth is limited. It's not like a pension. If you're a California state, you have hundreds and hundreds of years, so you literally can take some more risk, because if you don't get it right, you have time on your side. But as an individual, if you're only working for 40 years, you have to make sure you're making wise decisions, and taking too much risk in one company can wipe you out if you pick the wrong company. And so that's why having more than 20% in any one company, we really frown upon, because you're really putting yourself in an area where you could make more money, but you could also really financially challenge yourself, because if the stock really sells off and we go into a major downturn, that's going to really hurt.
Well, so us putting all our money into KHTS stock just because the Don and Gino show are here, probably not the wisest thing?
Probably not.
No more than 20%.
Are they publicly traded?
Only right here in Santa Cruz. Now, okay, so when we come back, we're going to talk about the sell in May and go away. You are going to be absolute shocked by the statistics regarding that statement. Seriously, you want to hear about this. It amazed me. When we come back to the Don and Gino Real Estate and Finance Show on your hometown station, AM 1220 KHTS.